Universal life insurance, it sounds like a financial Swiss Army knife, right? It protects your family, shelters money from taxes, and even builds generational wealth. And technically, it can do all those things if you know exactly how it works. But here's the problem. It's also one of the most misunderstood financial products out there. And if you don't watch out, it can leave you high and dry when you need it most. I'll walk you through the hidden pitfalls, the real risks, and how to check if your policy is actually working for you. Universal Life, or UL, is a permanent life insurance with an investment component. Unlike most term life insurance, which may seem to expire after a set period, but is often renewable at significantly higher premiums, UL, if set up correctly, is designed to last for life and build cash value, which you can access later. But remember, there may be tax implications. And here's where things get interesting. This is what's usually pitched to you. Flexible premiums. Pay more or less as needed. Tax-free growth. Your money grows without taxes eating away at it. Lifetime coverage. Unlike term insurance, your policy never expires. And then, of course, emergency fund option. Use the cash value if you need quick money. It sounds great, right? Not so fast, because here's what they don't tell you. These are the traps that could wreck your policy. Trap number one. The hidden time bomb. Rising cost. Here's where a lot of people get blindsided. There are two types of UL payment structures. One, level cost. It's predictable, flat premiums, but more expensive upfront. As long as you pay your policy, you're set. Yearly renewable term, YRT, or annual renewable term, ART. Starts out cheap, but gets way more expensive over time. So we will focus on YRT and ART. They seem attractive at first, especially if you're on a budget. But fast forward 20 plus years and that affordable $100 a month premium could skyrocket to hundreds or even thousands per month. If your investment fund hasn't kept up, you'll either have to pay out of pocket or worse, lose the policy entirely. And that's just the start. Trap number two, the illusion of paid up policies. Have you ever heard, just pay for 15, 20 years and you're set for life? That sounds amazing until reality kicks in. That's only true if your policy performs perfectly. If the market underperforms or costs increase, you may still have to make payments. Worst case scenario, your policy collapses, leaving you with nothing. Trap number three, the investment risk nobody talks about. You might think, no problem, I'll just rely on my cash value to keep my policy going. But what happens if the market tanks? Remember 2008? Suddenly your fund isn't growing fast enough to cover your rising insurance costs. And if the money runs out, your policy disappears along with all the premiums you've paid. Trap number four, the sneaky tax you're paying without knowing. Here is something most people never realize. Every province has a premium tax. Example, Ontario's is 2%. It's built into your premium. But if that tax increases, so does your cost. And guess what? That's really entirely out of your control. Okay? Trap number five, thinking you can just set it and forget it. This is a massive mistake. UL policies need regular checkups. If your broker isn't reviewing it with you every year, or if you're not asking them to, your policy could be on a slow march to disaster without you even knowing it. Here's a nightmare scenario. This happens more often than you think. Imagine this. You're 65 years old, you've been paying $100 a month for 20 years, so $24,000 in total. You assume you're done, but your fund only grew to $30,000 because returns were weaker than projected. Behind the scenes, that extra $6,000 in your fund has been covering the rising cost of insurance. But now at 65, your YRT insurance costs have jumped to $500 a month. Your fund helps offset this until it runs out. 1 year later, you get a letter from an insurance provider saying, well, you must start paying $500 a month or your policy will lapse, leaving you without coverage. And by now, you might be too old or unhealthy to qualify for a new policy. This isn't just a hypothetical. It happens to a lot of people every year. Now, how do you check if your policy is in trouble? Find your policy, check if it's YRT, ART, or level cost. Check the cash value by calling your broker and get an updated statement. Get a fresh projection. Ask for a new policy illustration with realistic returns, 3 to 4%, not the optimistic 8 to 10 they originally showed you. Talk to an expert. Get a second opinion from a licensed financial professional who isn't just trying to sell you something new. Bottom line, is UL right for you? UL can be a great tool, but only for the right person. Number one, high earners who've maxed out other tax shelters like RRSPs and TFSAs. People who actively manage and understand their policies. And then someone who needs permanent coverage with extra flexibility. For everyone else, YRT or ART Universal Life can be a risky, complex product if not structured correctly. So don't wait until it's too late. If you're unsure whether your policy is working for you or against you and you're in Canada, let's talk. I'll review it for you, no pressure, because the worst time to find out your insurance isn't working is when you, your family, or your business actually needs it.